Hello everybody and welcome to our practice exercise video for the periodic LIFO method. The LIFO of course stands for last in, first out. We've had previous videos covering periodic and perpetual FIFO, which those two methods are the same. We had a video covering perpetual LIFO, and now we're going to deal with periodic LIFO. Again, FIFO stands for first in, first out. LIFO stands for last in, first out. And it's all about the order that the inventory costs are pulled out of inventory and into cost of goods sold. So I recommend going through this entire series of videos to see the difference between the different methods. But of course, if you're just dealing with one method, one problem, you can focus on that instead. Now, the problem itself is going to be the same, except we're just using different methods. So the problem says Phoenix Industries had the following transactions throughout December 2020. So notice it's just 1 month of time. We'll see some pretty drastic cost increases, just really to illustrate the point. Now, the other thing I want to point out, though, is that you need to separate the cost from the sales price. We have a few different purchases of inventory as well as the beginning balance. For those, they give us the cost per unit. For the sales entries, they give us the sales price instead per unit. Now, the reason is they can't possibly give you the cost of those units sold because that's part of the problem. We're trying to figure out, for example, for this 125 units sold, we're trying to figure out what the actual cost is. It's not going to be just 11 or just 1175 or any of these other numbers necessarily. We need 125 units. We need to figure out which cost per unit do we pull them from. We only have so many units at $11, so many units at $11.75, so we need to figure out what order are we going to go in. Now, the sales price is important. Obviously, the sales price is going to be more than the cost, just by the nature of a for-profit enterprise. And we're going to deal with a few different questions down here. Some of them are going to be the same across different methods. Others are going to be specific to the methods. I'll just tell you 6 and 7 are going to be specific to whichever method you're using. So when you're faced with a problem like this, one of the first things I like to do is create a total column. So I'm just going to say total costs and total sales. And of course, we can only have the total cost on the actual cost lines, the either beginning balance or the purchased inventory. So it's going to simply be the number of units multiplied by the cost per unit. I'm just going to drag that down. But of course, we can eliminate the sales lines because instead they will have a sales price in total. So, and then also it might be handy to get a grand total of all of your costs and all of your sales price. So we know this, and I'll give you a hint that these two numbers are actually part of our questions. Just doing this answered two of our questions that we'll see in just a bit. But I like to do it up front just to get it out of the way. Sometimes the problem will already give you that. Sometimes it won't. So it just depends on the situation. I like to do it one way or the other. Now, if we go to questions 1, 2, and 3, they're talking about units. So we have nothing, it has nothing to do with the sales price or the cost, nothing to do with dollars in general. How many units were available for sale during the period? The available for sale, that's the key thing. We had 150 units to start with. We purchased 110 more. We purchased 85 more, and you can just keep going down the list. Notice that I skipped the units we actually sold. We're only looking for the units that are available for sale. All of those that we had, we could have sold throughout the period. Now, how many units were actually sold? If we go up to 125, and then 140, and then 150, we sold those units. How many units remained in ending inventory? It's the difference between these two numbers. We have 145 left in ending inventory. Pretty straightforward. We're just counting units at that point, adding them all up. Now we get to the value of the goods available for sale throughout the period. In other words, for these 560 units, what's the total cost of those goods? Not the sales price, just the cost. The good news is we already did that. This was what we were doing in this column right here, total costs of units available for sale. So we can just reference that right here. The total value of sales, we did that as well. We added those sales up. We're good to go. Now we're looking for the cost of goods that were sold throughout the period and the value of ending inventory. This is where the method will start to matter. The other thing I want to point out, though, is regardless of what method we're using, we have $6,850 of goods available for sale. That value has to be somewhere. It's either been sold, it's cost of goods sold, or whatever's left is the value of ending inventory. So what I'm going to say here is when we add numbers 6 and 7 together, we should equal this 6,850. Now, there might be situations in certain problems where there might be a small rounding variance. If you have like $11.33 for a cost, they might end up rounding because it's not going to be a perfect cents figure. It'll be a portion of a cent. But in this case, it's going to be nice and even. No rounding variances. So 6 and 7 is where the trouble is going to come into play, and it's going to be where the different method starts to matter. Everything else, these first 5 questions will be the exact same answer regardless of what method you're using. That's the point I want to make. Now, to do numbers 6 and 7, we actually can do them both together. There's a nice, easy way of doing that. And the way I like to illustrate this, again, I want to point out, though, that you might have different templates. Instructors have different templates. Textbooks have different templates. But if you're starting from scratch, what I like to do here is copy our data set, paste it down here a bit, and I'm going to call this ending inventory. Whoops. Because what we're going to do is and by the way, I need to eliminate these sales lines because they're not really our inventory. That's the usage of the inventory. So delete those sales lines. And what we're going to do is we're going to start pulling out of this, moving stuff over to cost of goods sold. And in the end, we should have a total balance of remaining inventory. And we'll have cost of goods sold at the same time. So I'm going to put cost of goods sold there. What I want to also do is bring back our totals. So I need to remultiply everything. And I'll do a grand total of all of these put together. So what'll happen is if we do it right, and if we have all these formulas in here, as soon as we start pulling out of ending inventory and moving it down to cost of goods sold, this will continue to decrease until we're left with our true ending inventory. Now for cost of goods sold, I'm going to add a couple of informational lines. You don't necessarily need to have these in your problem, but it helps to illustrate what's going on here. So we are in periodic LIFO. What periodic LIFO means is that we're going to do one cost of goods sold entry at the end of this month. So December 31st, that's the only time we're doing this cost of goods sold inventory or entry. The good news is on December 31st, we know everything about this data set. We know all of these different purchases, all these different costs, and we need to figure out how many units are we selling. We only do one sale, so it's going to handle all 3 of these sales at once. So it's actually easier. Perpetual LIFO, we have to do 3 separate sales entries. Periodic LIFO, we just do it once. Periodic by its nature is just easier. You have to do less. LIFO means we're going to start with the last layer available, and that's going to be the first one to go out, and then we'll work our way back up. So what we can do here is we can say this is going to be the December 31st entry. It's not a specific sale, it's the December 31st entry. And we're going to do it for all of the units sold. We had 415 units sold, so that's what we need to target. We need to somehow get 415 units. We're just doing it in one big entry, but we're going to have to pull from different layers. Now, if this was perpetual LIFO, which we talk about in another video, then on the December 7th sale, we wouldn't know anything about these two layers. We would only be able to pull from these we wouldn't know anything about these last three. We would only know about these first two. But since this is periodic, we know about everything. We can pull from every layer we need to. LIFO says we're going to pull from the last layer first and move our way back up. So what I'm going to say here, I'm going to call this the December 23rd layer. We just said we need 415 units sold, but we only have 95 units to pull from this layer. It's $13.75 a piece. Multiply it, and we get this amount. Now, the key thing to working this problem is if you're doing it in Excel like this, and if you want to do them both at once, every time you move a unit down, you have to update this as well. We're zeroing this out now because we've used it. We want 415, so we're certainly going to use this remaining 120 units of the next layer. That's the December 15th layer. I'm just going to copy that and update this. Those were $13 a piece, so we're going to zero that out as well. We're not even getting close. We still need the other 85. It's going to be the December 12th layer. And that is $12.25 a piece. We'll zero that out. So now we need to kind of do a quick check. We're getting closer to our 415 units. Right now we have 300 units that we've moved over. You can just highlight them and see the sum, or you can just do a quick formula to make sure. So we have 300. We need 415, so we need 115 more. The next layer has 110, so we're going to use all of that as well. That's the December 3rd layer. That was $11.75 per unit. I don't know why that's bolded. And now we just need, we need to update that first of all. We just need 5 more units, so we have to go to that last layer, December 1st layer. And it's $11 per unit. Unfortunately, that one was already multiplying. We need to update that as well to take our 5 away. So I'm going to do a total column here, or total line actually, just to make sure we have the right number of units and the right total. We need to figure out what the total is. 415 units, that's what we needed to sell. And you could also do a total back up here, which of course that's just 145. That's all that's left. So we have, that's a good check figure. We have the right number of units in ending inventory and in cost of goods sold. So we're good there. Just going to do a format here. So now we've answered 6 and 7 at the same time. The cost of goods sold throughout the period is this bottom number. The value of ending inventory is, of course, what's left. Now, earlier I said there's a good check figure to make sure you're on track, and that is that your cost of goods sold plus your ending inventory has to equal the total value of the goods available for sale. So just as a quick double check, we're going to add the two together. We get $68.50, which is what we wanted. So we are good to go there. This is the problem. That's the way to solve this problem. Again, there are a variety of ways to show it. I like using the fact that we're starting with ending inventory and moving out to cost of goods sold. That's just the way I like to work those problems. Hopefully that helps you to understand it as well. But I thank you for your time with this. I suggest you look at these other videos that we'll be posting. I have 2 left to complete, and they'll be posted here. That deals with the perpetual weighted average and periodic weighted average, and we'll see how that differs from FIFO and LIFO. So thanks for your time, and I look forward to talking to you in the next session.